Today I want to go over a poor man's covered call, or more appropriately called a diagonal call spread. I'm not really going to look at whether or not there's a good setup on the charts as I tell you about this, so don't pay attention to what securities I'm using to example, just look at the examples. What a poor man's covered call is when you use a long call that's usually a long time out in the future, typically 90 to 180 days, and you buy that deep in the money, and then preferably around a 1 delta or a 0.9 delta, which simply means that what you're paying for is the price of the stock, not the time value of the stock. As an example, if the stock was priced at $20 and you wanted to go out 180 days and buy a 10 call, then you'd want to pay around $10 for that, because you'd be paying just the value of the 10 to 20 difference. More likely you're going to pay about $11 for it. So that means you'll pay $10 in intrinsic value and $1 in time value. The other way to look at that is whether or not you're selling volatility or you're just selling a regular covered call type trade. And I'll show you both of those in just a second. The second part of a poor man's covered call is selling the short call in a closer term time frame against that long call you bought. So if the stock is trading at $20, you might want to sell a 22 call or a 21 call at 14 to 30 days out, just depending on what your premiums are and what kind of returns you're looking for and what your risk factor is. I'm going to take a look at VIX first. Again, don't pay attention to the stock itself, because I'm not really doing that setup. I'm just showing you how it would work. In VIX, I typically trade based on volatility, not so much the delta. So what I would want to do a poor man's covered call here is I'd want to sell about 11 to 14 days out, and I want to sell this 91% implied volatility. And I want to buy probably this January 23 or this December 151 at 64 and 61. So I'm selling the difference between these two is really what I'm trying to sell. So if we're looking at the December, I would come down here, and again, not really concerned about the delta on these. In fact, these deltas are not right. But I would want to buy maybe the 20 or the 18 for 860 to 940, and that would be my long. And then my short, I'm going to come up here, and I'm probably going to short somewhere looking for $1 to $1.45 for this initial trade. So I would probably sell one of these. So if I paid $8 for the long call at 20, then I sold the 27 for $1.15, we'll say, that would just give me about $6.85 or a debit. That would be my risk on this trade. I would set a good to close order and try to go ahead and close it for 8 to 10%. The one thing I want to watch out for is if VIX starts to spike above 27, then this becomes a little bit more difficult to deal with on any of the cash secured or any of the covered calls like this that you're doing a poor man's covered call, because these deltas will end up hurting you in the long run. The other way to do this type of trade is, we'll look at the VXX, because you can actually buy this stock, is you would still want to look at these volatilities. In fact, these are such a difference, I'm going to use a different one instead of VXX. I'm going to use SMH. So here you'll notice you're going to want to buy somewhere in this 90 to 180 range. You got 38, 39, 39. Let's take a look at the November for 119 days out. I have to expand my choices here. I'm looking for a close to 1 delta as I can get, which is going to be well here at 105. I'm not sure I want to spend 100 or 12,000 on this, so let's move this up to about an 80 delta on this one. So this one would cost me about $4,600 if I wanted to buy this 80 delta right here at 187. So I'd spend about $4,600 right here to buy this, and that will be my long call that I'm going to sell my short calls against. On the short calls, I'm probably going to go 21 to 28 days on these types trades, and I want to start looking at the 30 delta. Again, I'm expecting, based on the chart pattern, that the stock would go up. Now, I haven't looked at SMH, so it may not be true on this particular stock. But so I'd want to sell the 235 around that range. I'll make about $4 on that. So if I spent $4,600 on the long call, and I sell this for 400, then I'm going to have about $4,200 into this trade, and that's all the risk I have. This is a $235 or $225 stock, and I've got a trade on for $4,200. It's at 225, so if it goes up to this 235, that's another $10. So I would expect if it expired here, it say expired at 234.99, then all this value would go away. It would be zero, and the stock, my long stock that I paid $4,600, would now be worth about $5,600. So I'd have about $1,000 profit if it worked out that way. And that's how cash or a cover man's covered call works. I apologize. I keep trying to say cash secured put because I trade so many of those. But that's how a poor man's covered call works. If you have any other questions, just put them in the comments. Sorry that ended up rambling a little bit more than I usually do on my videos. But if you have any questions, let me know. Be sure to add comments and like it in the like section. Thanks.